It's not been a particularly good start to the markets in 2022. Here we are 3 weeks into the new year. And what's changed? Well, going into the back end of 2021, we already knew interest rates were going to go up, which seems to be the main thesis for this coming year. Politically, things haven't really changed an awful lot, and we're living with the pandemic. So where do we go in 2022? Well, joining us now for analysis of the year ahead is Robert Alster, Chief Investment Officer of Close Brothers Asset Management. Robert, good day to you. Good to be able to catch up with you in this early part of the year. As I said, it's not been a particularly good start to indices, at least, depending on where you're sitting in the markets at the moment. Certainly talking about where the financial markets are. Indices are my main idea here. What are your thoughts as we look out from this point on?
Well, if we take your first point about why things haven't worked out in the early parts of 2022, what we've seen is a rotation from growth stocks and equities and companies into value companies. So that's why, for example, the NASDAQ index in the United States, which is full of technology companies, has fallen, circa 10%, as people have been selling those to buy the more economically sensitive companies. And so that's the turbulence that you've seen. So that's what's happened so far. In terms of looking forward, the rest of 2022, I guess the one thing you do know is that interest rates are going to be higher at the end of it than they are now. So the big way that markets value equities versus bonds using interest rates is going to change. So that's the negative, if you like, the headwind that faces equities and shares during 2022. However, you also know that we're going to have a recovery, an economic and earnings recovery as we come out of Omicron and as economies pick up. So you've got a balancing act. It's like a dance going through 2022, and one misstep will lead to a correction, and then the market has to evaluate. So that's broadly how we see 2022.
As I said, interest rates, we knew about them going up at this time of the year anyway. Last time we knew that there was an upside to come because bond yields have been rising. And as you say, that does tend to impact these growth stocks more than others. But to your mind, is the situation changing? Is inflation becoming more entrenched? Are we less sure it's going to be a brief uptick in inflation and a pullback? Are you concerned that there is potentially the risk on the upside for inflation, which is what perhaps maybe some people are thinking about?
Yes, it's exactly what people are thinking about. And there's no doubt that the data has come through stronger than, we would have thought a year ago, and is likely to peak at around 6 or 7%, for example, in the UK at some point in the Easter. But we think it's going to then tail off after that. The energy may be high, but there's anniversary effects going through. The supply chain issues that have been pushing prices up will alleviate. So from our point of view, we think it's going to alleviate. So for us, it isn't a longer term structural negative that other market commentators believe in.
When we spoke to you last summer, you were talking then quite confidently, and it turned out well, that you felt that there was an underperformance of the London markets compared to the rest of Europe and compared to some of the other Western economies around the world. Do you still hold that view? As of this morning, in fact, the FTSE 100 was knocking on the door of almost 2-year highs, pre-COVID highs at least. And of course, this does seem to indicate an outperformance in this part of the market cycle. Do you see that continuing, despite the fact that the Bank of England is likely to raise interest rates?
Yes, you're right. The UK got to very low valuations by any standards, going back 10, 20 years even. And that, plus this rotation into value, with the market believing that economically cyclical stocks will move up, drove a large part of that UK outperformance. So you can see the energy and material companies in the UK driving that. And I think that will continue for some time, but then I'm not so sure. So for us, in terms of the way that we look at it, we're overweight equities for 2022, with a preference still for the US. But I agree, at the moment, the UK is going to have a run, and that will continue for the next few months, definitely.
So what you're talking about, lower lows in the next few months before recovery, is that your best case?
I think I think it's this dance. I think it depends very much on how the inflation data comes through. For us, we believe it's going to peak in the Easter, so markets are going to be choppy. And then as inflation comes down and we readjust to economic growth picking up and inflation moderating, not spiking higher, then I think markets will be well underpinned going into the second half.
Do you not think there's going to be a headwind starting to develop, though, from the consumer, especially if interest rates do go up, which is the best case? I was talking to the chief economist at Panmure Gordon a short while ago, and he was saying, yes, there's almost certainly going to be 2 interest rate rises, possibly 3. We may get more in the States. And of course, when you get the consumers so highly indebted, as indeed we are at the moment, if you look at the data, that is going to cause a lot of stress, I'd have thought, on individual household accounts, and it means then that people just don't have the money to continue to live the lifestyle they've lived. So surely that's going to cause a bit of a headwind, isn't it?
I agree that there is going to be pressure on, especially on real wages, because inflation is going to outpace wage growth. But you also got to remember that people have been saving up now for 2 years, unable to spend apart from the brief periods between lockdowns. They want to go on holiday, they want to spend on services. So the offset to that slight negative going forward is how much are people going to unwind their savings to maintain their standard of living and sort of regain the life they led prior to the pandemic. And I think that's a balance, and I suspect it's going to be quite substantial, and the consumer won't relapse into some sort of consumer recession and retrench.
So what sort of, when the recovery comes after Easter, assuming we do get this peak in inflation and we do then look upon the rest of the year as an opportunity to buy in, which areas are going to succeed most? Do we return into growth, or do we maintain our look at the more traditional companies, the cyclically responsive companies, those companies that do well when the recovery is coming through?
Yeah, I think it's going to be a mix. I think it then comes down to an analysis of the fundamentals of each sector. So I think, for example, companies that have strong pricing power, they will do well. So companies in niche areas that consumers really need to have. Also, some cyclically sensitive companies will do well where there's commodity price inflation in that particular area. But yes, your point about a return to growth, I suspect, does happen. You know, we are at the structural foothills of certain growth sectors, of which, you know, technology is one. And I think the market will then realize as growth moderates and we're back to a more normal world, that growth companies are the places to be for the longer term.
And whereabouts in the rest of the world is it worth looking? We spoke about the London markets. You talked about your preference for US. What about, well, Europe, first of all, the EU, and then further afield into emerging markets? Are you interested there at all, or do you think there's little to be had in terms of opportunity later in the year?
Europe's an interesting case because it's sort of lagged in terms of the whole vaccine program and in terms of stimulus, and also it's got a big exposure to China via Germany and some of the other countries, and we should come on and talk about China. So Europe is going to be more dependent on China, and I think it's going to just take longer for Europe to rebound. You've got to sort of discriminate in Europe because you've got the southern countries, the southern nations and countries that you know, are bound up to hospitality and holidays, and they're going to clearly see a big rebound. But Central Europe is, I think, going to have a moderate recovery, and then it will be dependent on China. And of course, it will be underpinned by all the recovery programs that each country has put in place. So, you know, your question, are there investments in there? Yes, there are, but you have to be picky and discriminatory.
Let's pick up on that point about China, particularly because today we've seen them row back a little bit on interest rates and the lending market. And I think, I mean, the part of the point about this is they're obviously trying to make it easier for their property sector, particularly, which has come under a lot of pressure recently. And indeed, at the back end of last year, it was one of the big threats, I think, that some people were looking at possibly, that we could well see a sort of a Lehman type moment to developing in China. That doesn't seem now to be the case. China does seem to be on top of it, but nonetheless, these big property companies still verging on the default. The Chinese authorities as well clamping down on tech companies as well. What's your attitude to investing in and around China and taking opportunities that are China exposed? Because clearly the Chinese markets have sort of a frailty to them at the moment.
Yes, I think frailty is a good way of describing it. And from that point of view, we're standing on the sidelines waiting to see what happens. I think you're right about there's a slowdown in China, but at the same time, you know that it's a very centrally command economy. And that's one of the reasons that property problem is not going to be allowed to ripple through other parts. So you're going to see sort of circa, I think, 5%, 4-5% growth, and they will stimulate the economy more. There's a credit impulse chart that looks at the overall stimulus being applied to the Chinese economy, and that's bottoming out. So China is going to recover. I don't think that property scandal is going to ripple or have any deleterious longer term effects. And of course, they want to shift the economy more to the consumer. And that is a stated policy objective, which, you know, we will see over the next 4 or 5 years, they'll roll out.
One final question, and one potential headwind for the markets is this ESG angle that we hear so much about these days, the idea of us being pushed into relatively expensive areas of the economy. We're looking to take on electric vehicles, far more expensive than combustion engine vehicles, and some suggestions that even the authorities are going to try and regulate the markets to try and force us into investments that have an ESG angle to them. Do you, as a Chief Investment Officer, worry about this at all? Do you think that we are being, as I say, funneled into potentially expensive areas that will ultimately cost us a lot of money? Do you think this whole ESG thing is moving too fast?
I think it's moving very quickly. After COP26 and lots of pressure from shareholders, from clients, ESG is probably the single biggest structural driver over the next 10 years to investments. And we're only beginning to understand the implications, the carbon emissions, the real granularity of individual companies. But this is going to just keep going with more pressure and depth. And so every asset management company, wealth management company like ourselves just does increasing the amounts of work on this area in terms of asking companies questions and assessing their ESG credentials. That continues.
Okay, Robert, we'll leave it there, but thanks indeed for joining us. Robert Alster is the Chief Investment Officer of Close Brothers Asset Management, taking a look at the markets there with his best case of an opportunity, perhaps maybe to get into some areas of the market after Easter. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.